Welcome to Berman's Call. We are here to take your questions today on stocks and ETFs. Here's how to reach us. 1-855-326-6266. You can email us your questions as well. Berman's Call at BNNBloomberg.ca. And Larry Berman joins us now to talk some more about what has been going on. Larry, the Bank of Canada and the U.S. Federal Reserve make announcements on Wednesday. Let's start with Canada. Stronger job numbers, GDP growth. Do you expect to hold?
Yeah, absolutely. In fact, we saw a dramatic repricing of the directionality of the next move from the Bank of Canada following the labor numbers on Friday. So the next move, much later in 2026, is now expected to be a rate hike by the Bank of Canada. So that's how dramatic of a surprise that was. And we saw that mostly manifested in a very strong move in the Canadian dollar, because we now have the Fed that's likely going to continue to cut rates slowly, perhaps catch up to where the Bank of Canada is, and now you have the potential for the Bank of Canada to raise rates. I think that's out to lunch, frankly, on what the market's priced in, but that's what the market-based pricing is telling us at the moment.
Yeah, a few other factors for the U.S. Fed. Of course, Powell will be leaving, so you're still expecting the rate cut for December, and then somebody else will take over. Do you think the last big decision for Powell will be December, and he's kind of has his hands tied, depending on who the new federal chair is for the start of the year?
No, I don't think so. He's a guy who's demonstrated that he's the boss, and so he's still in the room until May. And if the data warrants, he'll raise rates or cut rates, depending on what needs to be. Now, obviously, it's going to be harder to cut rates. So I think what we will see this week is what we call a hawkish cut, in that they'll cut rates, but they'll signal again the path is slower because they are still worried about inflation. Yet at the same time, the data that came in and what they did see, even though the government was out, warranted another a move.
But there's always a problem, right? A disconnect between what you get from the government offices officially and what comes out from some of the other companies that track this kind of thing. So how do they sort of write that?
Well, they look at everything in its totality, is the word that Chairman Powell likes to use, and then they individually make up their minds on which one's more important. I think an ADP type number is I mean, they do payrolls for, 25% of U.S. companies, small, mid, and large. So it's a really good data set. It's better, in fact, than the survey type data I think that the government does. But that's my opinion. It's certainly not consensus.
Okay, so a big picture, if in the new year, as it seems it's going to be, you get somebody who will cut the rate because that's what Washington wants to see happen. How do you think that'll play out on a more macro level?
Well, that's the problem, and that's the debate and discussion right now going on in investment committees everywhere in the world. Is the Fed going to lose its independence under the thumb of President Trump? And I hope not. I think most people hope that we don't see that, but the reality is there's going to be much more cooperation between the FOMC and the Treasury under the next regime than anything we've seen in decades.
Okay, cooperation or sort of a straight, here's what I want to happen. I'm assuming that if somebody gets put in place and they are aligned with Donald Trump, no one would expect them to sort of go their own way and make a decision that's away from what Washington wants.
Yeah, I think anybody he nominates, with the exception of his son, apparently Berman is in one of these Polymarket polls as someone who might be appointed, which would be laughable, of course, and would never get through Congress. But someone shared a Polymarket poll where they had, potential candidates on the probabilities. It's still very much likely going to be Hassett at this point. I'd be surprised if they went in any other direction. But they are leaving that name out there. They are seeing if the market can digest it. So far, so good. We have seen a little bit of a backup in the long end of the U.S. curve into auction supply this week. It'll be pretty important to see how that clears the market in terms of the direction of the next pressure on the bond market or lack thereof.
All right, we will take a quick break. We'll light up the first phone calls and emails for Larry Berman. Here's how to reach us again. We're back in just a moment. Welcome back to Berman's Call. We are here with Larry Berman to tackle your questions, and we will start with an email question from Scott. He says, in the past, Larry, you mentioned being cautious with regards to commodities. You specifically mentioned precious metals. Does your caution extend to other metals, so uranium and copper? I have a position in Cameco that has done well, but I still believe in the long-term thesis for nuclear power. Would you trim uranium-related stocks or hold for a longer term? So very specific question. I'm sure we've talked about gold and silver, Larry, so a more specific question about copper and uranium.
Yeah, I've been very bullish on both in recent years. But when you look at Cameco as an example, here's a stock that's trading at 90 times trailing earnings, 60 times next year's earnings. The question is it going to grow into the earnings, or are we going to get a price correction before? And I would argue here that Cameco is going to trade down to 80 before earnings catch up to what's being priced in. So I'm very, very cautious on some of these stocks that have run up in anticipation of higher prices in the uranium space. In the copper space, we haven't seen to the same extent that ramp up. So cautious overall, because I think while we're going to likely see an attempt to run the economy hot in 2026, and there's a mandate from the U.S. administration to do that, I do think that we get a harder landing at some point. I just can't time it for sure. So I'd be cautious chasing strength. I'm okay buying into weakness. Now, the question is, do you want to trade that? Well, if it's in a registered account, then have fun with it. There's no tax complications. But if you're in a taxable account, you got to be mindful of the big picture. And for both of those sectors, longer term, I would still be bullish. But I think in the case of Cameco, we're probably pricing in revenues, in the 5 years from now category. So more cautious there than I am on the copper side.
All right. Okay, let's go to our first phone call then from Phil, who's on the line in Vernon, BC. Hi, Phil.
Hi, how you doing?
Good, thanks. Go ahead.
Larry, I was just curious on gold and silver. I know you've taken a lot of calls on it. I'm using the Amex, AMAX for gold, and SILJ for silver, and I was wondering if I should be buying on the dips over the next year, putting in some new money, or should I be trimming that position?
Yeah, so the yield maximizer ETFs, they're great products for income. But if you're going to be really bullish on the space, preference would be just to be in the outright stocks or the bullion, as opposed to the option covered call strategies that give you extra yield. You're going to underperform in the long run, likely, if you're bullish. If you think we've capped for a while and you're going to go into the trading range type market, I like these yield maximizers to keep your exposure and generate extra income while you're waiting on the consolidation. If you're talking about buying into dips, I would buy into the pure bullion type exposure or the pure equity type exposures without the derivative overlay. That's the income enhancer. So those are my rules of thumb, and it doesn't matter if it's silver or gold or any sector for that matter.
Okay, I hope that is good for Phil. Let's go to Sharon from Chilliwack in BC with a question. Hi, Sharon.
Hi.
Go ahead.
Okay, I bought Pinbean about 25 years ago for $25 a share, and I enjoyed the dividends that it pays back, but I was wondering, it has not come back to $25, just one little peak, and I didn't sell then to get out. Do I sell or do I hang on? I'd like to know, Larry.
Okay, thank you for the question. I have Pembina Pipeline at 54.88 today, up 527 points. I'm not sure if that timeline is, okay, so that goes all the way back to about 2002. What would you do? Would you trim, Larry?
Well, here's a great example. You look at the pre-fracking peak in Pembina in 2014, let's call it. And you draw a straight line across with your eyes when this was around 50, maybe it peaked in that range. You can see we're not materially above that in the last decade, with a lot of noise in between. So when something gets priced for premium, you got to be careful about the forward-based returns. And that's the point I make in all these things. Market runs up, you're going to see a period or a long period of time where the market just catches up to what's being already priced in. I'm not saying that's the case with Pembina right now. Well-operated, good company. But if you look at what analysts think it's worth a year from now, it's upper 50s. So buy it below 50, sell it in the upper 50s. That would be my recommendation looking out a year or so, and then subject to revision. So I think we're sideways chop for the next year or two. And that's probably your best case scenario. There's no more growth story here in pipelines. I'd like to believe Canada's going to see some pipeline expansion. We'll see if the Carney government lives up to their promises. Okay, and there was that memorandum of agreement. As you say, we'll see how far that gets. Okay, let's go to an email from Ash, who says, does the ZPay ETF use leverage? Larry, does it? Yeah, it does not. And again, it's cash covered. So when you look at the ETF and you look at its holdings, you would see a lot of cash. Or T-bills, typically, that they're holding. And those are covering the naked puts they're writing on to acquire other securities. But there's no use of leverage in this product. There are some in the marketplace that do use leverage. There's nothing wrong with it, but the BMO version does not. Okay, that answers that question. Let's get to another email from Catherine. Would the iShares Global Dividend ETF, XDG, be a smart holding in a non-registered account as opposed to in a TFSA? What do you consider when making that decision? It's after tax. In a registered account, there's no tax consequences. So when you're seeking a dividend, even though it's a Canadian listed ETF, when that source of dividends, 97% in this ETF, are coming from foreign corporations, there's no dividend tax credit benefit. So to hold it in a TFSA gives you a much better after-tax total return than holding it in a taxable account where you're going to be treated as ordinary income on that dividend. The only benefit is when that dividend comes from a Canadian corporation. Again, an ETF does not qualify for that. So be very, very clear on that, but it's an excellent question. Okay, so tax considerations there. Let's move on to an email from Bruce, who says, could Larry comment on a short-term and long-term outlook for ARC Resources? ARC Resources, natural gas play for many people, has come back a little bit from sort of the mid of the year where it was down quite a bit. It's at $27.12 today. So it's up 11% over the year, just 1% today, 1.5% almost there. What is your outlook for ARC Resources, Larry? Yeah, in the last few months, and even I would say in the last year and a bit, I've been a buyer on dips. But again, I don't see a real robust growth story. I think we're oversupplied in natural gas in North America. And until some of these Canadian names get more distribution in terms of pipeline capacity to the coast, then I see it constrained from a growth perspective. So call it a range trader. Analysts think it's worth a little over $30. 12 months out, I would be a seller in that range. And, any dips into the mid-20s right now is probably a buy. So Canada's been working on its capacity to get more gas out to other markets, Europe and Asia. And there's some capacity and there's some build out now. You don't think that's worth holding on to? Yeah, to $30.
That's it.
Not at this point. Yeah, we need a lot more, not just baby steps in terms of what we've seen so far. So we have the capacity to supply a good part of Greater Asia, Japan in particular, parts of Europe, but we just don't have the capacity to distribute it.
Okay, and that's coming too far down the line, you think, for a company like this to make sense of it anytime soon?
My opinion doesn't mean that's the fact.
Okay. All right, let's get to another email. This one's from Don. He says, what do you think about an investment by grandparents in ZGLD for use by two grandchildren starting in about 4 years when they start their higher education as a supplement to their RESP invested in equities held by their parents? Thanks, Don. So this is, again, the parents asking about an investment for the grandparents, for the grandchildren. Is this a good way to do it, ZGLD?
We've seen long periods of time where gold bullion has had negative returns. And I think we're going to see that again at some point. We've had a tremendous run up. So if you're talking about putting money away for a newborn that they would use in 20 years, after the run we've had, I'm not sure gold is the growth category you want to put that money in. Having said that, equity markets are pretty expensive too. So as a diversifier, I'd be okay with 5% of their RESP money in a gold bullion ETF, but not more than that. So again, as a diversifier and another source of potential growth, sure. I don't know, maybe it goes to $10,000 in terms of gold bullion over that horizon or quicker. But, I wouldn't bet heavily on it as opposed to thinking about it from a diversified portfolio perspective.
Okay. We are going to leave the phone calls and emails there, but coming up is Larry's educational segment. We're back in a moment.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. We are here with Larry Berman, and it's time for his educational segment. Larry, you want to start with a look at bonds?
Yeah, following the employment numbers in Canada last week, I was a bit shocked to see the reaction in the bond market, where at the front end of the curve, they're now starting to price in the next move being a rate hike. And I've said, Morella, here, for the better part of 10 years. It started around the Brexit timeframe where interest rates in Japan had already been negative. That moved into Europe. We had zero interest rates at the front end of the curve for the better part of a decade following the GFC. That traditional fixed income would be terrible for individual investors as the safe part of their portfolio. So examining that back with a look back, first chart here is the XBB, and that's the iShare Aggregate Canadian Bond Market ETF. That's generated an average annual return of 1.86% since the end of 2014. Pretty bad relative to inflation. So if that was your safe part of your portfolio after inflation, you are not better off. If you look at corporate bonds, which gives you a little bit extra yield, a little bit more risk, but a little bit extra yield, XCB, corporate bond benchmark, passive index, 2.79. So again, barely keeping up with inflation. Now, you can find some good active bond managers in Canada. There are a number of them out there. They've managed to, the top quartile performers, managed to generate 5 to 6% for you. So that's been better since some of those passive approach. But my point being, and I've started to talk about this in recent years, look at private credit investing, because typically on a go-forward basis, your minimum returns in funds like that are going to be in the 5 to 6% range, where you could find funds that are delivering in the low teens at this point. There are several really good ones in Canada. Now, I'm going to stop short of making recommendations. Some of them are trying to advertise right now on BNN because they're attractive asset classes, and I don't want to single out any one over the other from that perspective. But when we look at the response of the Canadian bond market on the next graph here, post the data on Friday, you could see that sharp downturn there in the last couple days, but really happened on Friday, where we almost lost a full dollar in terms of that, or 1% in terms of that bond market exposure on those two ETFs. And so on a year-to-date basis, your bond portfolio isn't doing well. And so I'm actually going to be at an alternatives conference this week in Miami. There's challenges with valuation in equity markets. There's a great graphic here that shows what your forward-based return is going to be likely and historically actual over the next 12 months if the last 36 months has been really, really strong. So we're at the point now where the last 36 months has registered a 2 standard deviation move. And so on a forward basis, equity markets are now going to deliver or likely to deliver flat or negative returns on average or median in the last 100 years of U.S. large cap equities. So you have both bonds and equities that are pretty significantly challenged as a market class. And I think investors need to start looking at private markets for other alternative ways of generating returns in their portfolio where we have challenges in whether it's the bond market or the valuation in equities.
Okay, I also want to ask you about active versus passive fixed income and that approach. I mean, how do you determine, first of all, what's the difference? What would you consider passive? What would you consider active? And if you're an investor, what do you need to know?
Yeah, so passive, low-cost ETFs tracking an index. An active manager is going to select the right bonds, the right part of the yield curve. They're going to make interest rate bets being longer or shorter in duration. And some of them are very good at it, but most of them historically don't deviate too much from the index in Canada. So you're paying active fees, but you're not necessarily getting real active management in terms of compensation for those extra fees. So I'd stick with the passive, but I'd look at private markets for alternatives to fixed income and even in private equity these days.
Okay, we do have to leave it there. We're out of time. But if you would like to follow Larry, you can do that online. There's a number of different ways. He's on LinkedIn. He's on X. You can find him on YouTube as well. The website is qwealth.com. That does it for today's show. Thanks for joining us. And the close is coming up next, so stay tuned for that.